Imagine this. You've just inherited a house, maybe the one you grew up in, filled with a lifetime of memories. It's an incredible gift, right? An emotional anchor.
Absolutely.
But then the practical side kicks in. You start thinking, what about the taxes? Specifically, what happens if you decide to sell this treasured property down the road? You know about capital gains tax, right? It's usually based on the difference between what you paid for an asset and what you sell it for. That difference is called your capital gain, and, well, it can mean a big tax bill.
A very big bill sometimes.
But here's where it gets really interesting, especially with inherited U.S. real estate. There's this powerful tax rule that can drastically reduce or even completely wipe out capital gains tax on all the value that property gained before it ever came into your hands.
That's exactly right. This often comes down to understanding something pretty fundamental in tax law called cost basis, and a very specific and frankly advantageous adjustment to that basis that happens when property is inherited. It's called the step-up in basis.
Step-up in basis.
Okay. And this isn't just some minor detail. It's genuinely one of the most significant tax advantages available to heirs in the United States, particularly when we're talking about assets like real estate that have, appreciated a lot over long periods.
Okay, let's unpack this then. Our mission in this deep dive is to clearly define what cost basis is, but, quickly move to showing you exactly how that step up works, specifically for inherited U.S. real estate.
Yeah, get right to the good stuff.
Exactly. We'll explain why it can make such a huge financial difference. We'll compare inheriting property to receiving it as a gift during someone's lifetime, because that's different.
Very different, critically different.
Right. And we'll explore how things like trusts and state laws can affect it, and finally, take a peek at the current discussions and, well, the potential future of this powerful rule. Think of this as your shortcut to understanding a crucial piece of the inheritance puzzle.
It's absolutely crucial, and understanding basis is the necessary first step, even if, we don't need to become tax accountants today.
Definitely not aiming for that.
No. But at its core, the IRS defines basis as, essentially, your investment in property for tax purposes. It's the starting number, the baseline you use to figure out things like depreciation if it's rental property, certain losses, and most importantly for our chat, your gain or loss when you eventually sell or dispose of the property.
Got it. So if I buy a stock for $10, my basis is $10. Simple enough. If I sell it for $15, the gain is $5, right?
Yeah.
That's my initial cost basis based on a simple purchase.
Exactly. That's the most straightforward example. If you buy property, your basis is generally your cost. But the IRS definition of cost for something like real estate is a bit broader than just the price tag you paid.
Okay, how so?
Well, according to IRS Publication 551, which is kind of the go-to source here, it includes the amount you pay in cash, sure, but also the amount of any debt you take on or assume as part of the purchase, and even the value of other property or services you might have exchanged to get it.
Okay. So if I buy a building for $20,000 cash and I also take out or assume an $80,000 mortgage, my basis isn't just the $20K cash. It's the full $100,000, the total amount of cash and debt used to acquire it. That makes sense.
Precisely. That's your starting point. But beyond the direct purchase price or assumed debt, you also add certain other costs associated with actually acquiring the property to your basis. These are costs that are, necessary to get the property and get it ready for its intended use.
Like what specifically? What kind of costs are we talking about?
The IRS lists things like sales tax on the purchase, if that applies, freight charges, if it's, say, business equipment, installation and testing costs for business property, excise taxes, and crucially for real estate, it includes legal and accounting fees directly tied to the purchase that had to be capitalized. Things like revenue stamps, recording fees.
Okay.
And surprisingly to some, real estate taxes that you as the buyer specifically agree to assume and pay for the seller's portion of the tax year. That becomes part of your cost.
Okay. And what about all those closing costs? The settlement fees.
Yes, absolutely. Closing costs and settlement fees directly related to buying the property, things like title insurance, but specifically your policy, not the lender's policy.
Right.
Attorney fees for the closing itself, survey fees if you got one, fees for recording the deed, all those necessary costs of the transaction are added to your basis. Even if you bought it entirely for cash, those expenses become part of your investment in the property for tax purposes.
So those increase your basis. That's good to know. What about costs that are not added? I remember reading that the source distinguished between the costs of the property itself versus the costs of financing it.
That's a critical distinction. And yeah, you're right. Generally, costs related to securing a loan to buy the property are not added to your basis.
Okay, so like mortgage points.
Exactly. Points paid to get the mortgage, whether they're discount points or loan origination fees, mortgage insurance premiums, credit report fees, appraisal fees required by the lender, fees for guaranteeing or insuring the mortgage. Those are all loan costs, and costs for refinancing a mortgage later on. Also not added to the property's basis. These loan costs, they might be deductible over the life of the loan, especially if it's business or rental property, but they aren't considered part of your capital investment in the property itself.
Okay.
Also excluded are things like casualty insurance premiums, your homeowner's insurance, or prorated rent and utility charges for the period before you officially closed and took ownership.
Okay, that makes sense. So basis starts with the cost of acquisition purchase price, assumed debt, direct buying costs, but not the loan costs. That gives us our initial basis, our starting point. But this number isn't fixed forever, is it? It gets adjusted over time.
Exactly right. That's your original basis. Over the time you own the property, certain events require you to increase or decrease this original basis. The result is what's called your adjusted basis.
Adjusted basis.
And that adjusted basis is the number you actually use when you finally sell or dispose of the property to figure out your gain or loss.
Okay, so what kind of things increase your basis over time? Make it go up.
Think of investments you make that add significant value to the property or substantially prolong its life, things with a useful life of more than 1 year. This is where the costs of major improvements come in.
Like putting on a new roof.
Exactly.
Yeah.
A full roof replacement, not just patching a leak. Putting in a completely new kitchen or bathroom.
Yeah.
Building an addition or an extension. Upgrading the entire electrical system. Those are capital improvements.
Right.
It also includes things like costs to extend utility lines to the property, certain impact fees charged by the local government, legal fees you might pay to, say, defend your ownership title to the property if there's a dispute.
Okay.
Or even assessments paid for local improvements that specifically increase the value of your property, like the city paving a road right in front of your house or installing new sidewalks that directly benefit your property.
The source mentioned a city mall example, right? Like paving streets for that.
Yes, assessments for those kinds of local improvements that increase property value are added to basis. The key is that these are costs that add capital value, not just routine repairs or maintenance. Fixing a broken window is a repair. Replacing all the windows with energy-efficient ones is likely an improvement. Repairs are typically deductible expenses for rental property or just personal expenses for a home. They don't increase basis.
Okay, so major upgrades or costs that enhance the property's long-term value increase your basis. Got it. What about the things that decrease it, make it go down?
The primary driver of a decrease in basis, especially for business or rental property, is depreciation.
Depreciation. Right.
This is the amount of depreciation you've deducted over the years for wear and tear or obsolescence. Or, and this is crucial, the amount you could have deducted under the law, even if you didn't actually take the deduction on your tax return.
Wait, even if you didn't take it, why?
Because the IRS requires you to reduce your basis by the depreciation allowed or allowable. This prevents you from getting a tax break now by skipping the depreciation deductions and then effectively getting another break later by having a higher basis when you sell, which would result in a smaller capital gain. You have to account for the depreciation you are entitled to take.
Okay, that's important. Allowed or allowable. What else decreases basis besides depreciation?
Other things can include deductions you've claimed for casualty or theft losses, say, damage from a storm, but that reduction is offset by any insurance reimbursement you receive. Certain energy credits or vehicle credits you might have received related to the property can reduce basis. Debt on the property that was canceled and you were able to exclude that canceled debt from your income, that reduces basis. Amounts you receive for granting an easement, like letting the utility company run lines across your land, and certain rebates that are treated as a reduction in the purchase price.
Okay, depreciation seems particularly important for rental property owners to track meticulously. The adjusted basis calculation example from the IRS publication, Pub 551, it really showed how you start with the initial cost, then you add the cost of major improvements, and then you subtract years and years of depreciation, plus maybe a casualty loss you claimed, to arrive at the current adjusted basis. It really is a running tally, isn't it?
It absolutely is. And keeping good records, invoices, receipts for improvements, tracking depreciation claimed is vital, because this adjusted basis number directly impacts the actual tax you'll pay when you eventually sell.
Now, we've talked about buying property and adjusting the basis. What about if you change how you use the property? Like, say, you convert your personal home into a rental property. How does that affect the basis?
Yes, that introduces a specific and slightly tricky rule. When you convert property from personal use, like your primary home, to business or rental use, you actually have a different basis for depreciation purposes than you might have for figuring a gain or loss when you eventually sell it.
Different basis. How does that work?
For calculating depreciation on the now rental property, your starting basis is the lesser of two numbers, either the property's fair market value, FMV, on the date you make the change, or your adjusted basis on that same date.
The lesser of the two. Why the lesser amount?
It's designed to prevent you from taking depreciation deductions on any decrease in value that happened while it was still your personal property. You can only start depreciating the property's value as an income-producing asset from the point of conversion and based on its value at that time, or your original investment cost if that was lower.
Okay.
The IRS example illustrates this pretty well. If your house had an adjusted basis of, say, $178,000, that's original cost plus improvements minus a casualty loss you claimed while living there. But its fair market value as a house was only $165,000 on the day you converted it to a rental.
Then your basis for depreciation starts at $165,000.
Exactly. You're limited to the $165,000 FMV for depreciation purposes because that was its value when it entered service as a rental.
Okay, that's for depreciation. And what about for calculating gain or loss when you eventually sell that rental property later?
Right. So for figuring a gain when you sell, your basis is your adjusted basis on the date of the sale. This typically starts with your original cost basis for the entire property, including the land. Remember, land isn't depreciable, but it's part of your overall investment. Plus any capital improvements you made after you converted it to rental, minus the depreciation you actually took or were allowed to take since the conversion. Following that IRS example, if the total original adjusted basis for the house and land was, say, $203,000 before conversion, and then you took $37,500 in depreciation deductions while it was a rental.
Then your basis for calculating a gain upon sale would be $203,000 minus $37,500, which is $165,500.
Correct. If you sold it for more than $165,500, you'd have a taxable gain calculated for that basis.
Okay. And for calculating a loss, is that different again?
It is. For figuring a loss, you start with the smaller of two numbers, either your adjusted basis for the entire property or the fair market value of the entire property, both measured at the time you converted it to rental use.
Okay, so back to the value at conversion again.
Right. Then you take that smaller number and adjust it for the period after the change primarily. You subtract the depreciation taken during the rental period.
Ah, okay.
So in the example, if your adjusted basis was $203,000, but the FMV at conversion was lower, say $180,000, you have to start your loss calculation with the $180,000 figure. Then you subtract the $37,500 depreciation taken while it was a rental. That gives you a basis for loss of $142,500.
So what does that mean practically?
It means if you sell the property for less than $142,500, you have a deductible loss. If you sell it for more than the gain basis we calculated earlier, $165,500, you have a taxable gain.
And if the sale price falls in between those two numbers, between $142,500 and $165,500?
Then, interestingly, you have neither a taxable gain nor a deductible loss. You're in a sort of neutral zone. It's a complex set of rules, for sure, but it's logically aimed at properly allocating any value changes based on whether they occurred during personal use or rental use.
Wow. Okay. So understanding basis, how it's calculated initially, how it gets adjusted over time, and these special rules for converting property use, it's clearly foundational for property owners, especially those with rental properties.
Absolutely.
But everything we've discussed so far, buying, building, converting, adjusting, applies to property you actively acquire or change the use of. This really sets the stage perfectly for the core topic of this deep dive, how basis is handled when you inherit property, and why it's so different and often, well, incredibly beneficial.
This is it. This is the stepped-up advantage, and it's a completely different ballgame from buying property or even receiving it as a gift. When you inherit property in the United States, your basis is not the deceased person's original cost basis, no matter how low it might have been, from decades ago.
Okay, so what is it then?
Your basis is stepped up, or sometimes stepped down, if the value decreased, though that's less common with real estate over long periods, to the property's fair market value, FMV, as of the date of the individual's death.
The date they passed away.
Yes. There's also an option called the alternate valuation date, which is typically 6 months after death. An estate might elect to use this date for estate tax purposes, maybe if values drop significantly after death. If they elect that, then that alternate date value is used for the basis step-up. But the core principle is the same. The basis is reset to a recent market value near the time of death.
Okay, so instead of stepping into the shoes of the person who died and taking on their potentially ancient, very low historical cost basis,
Right.
you get a completely fresh start, a new starting point based on what the property was actually worth right around the time they passed away.
Precisely. And this is where the enormous tax advantage lies. This stepped-up basis effectively eliminates any capital gains tax liability on all the appreciation that occurred during the deceased person's entire lifetime.
All of it.
All of it. If you inherit a property with a stepped-up basis and you later sell it, you only owe capital gains tax on any appreciation that happens after the date you inherited it, measured from that new, higher stepped-up basis.
Let's put some numbers on this because that sounds almost too good to be true. Imagine a grandparent bought a house decades ago for, let's say, $50,000.
Okay.
Over the years, it appreciates significantly, market goes up, whatever. By the time they pass away, it's worth $500,000. If I inherit it, what's my basis?
Your basis is $500,000, the fair market value at the date of death.
Wow. Okay. And if I were to sell it fairly shortly after inheriting it for, say, $510,000, what's my taxable gain?
Your capital gain would be just $10,000. That's the $510,000 selling price minus your $500,000 stepped-up basis.
So what happened to the other $450,000 of appreciation, the gain from $50K to $500K?
Poof, gone. For capital gains tax purposes, it's completely tax-free for you, the heir. Wiped away by the step-up.
$450,000 of tax-free appreciation. That is absolutely staggering compared to the alternative.
It really is.
Edel Strategies used a stock example that makes this crystal clear too, right? Someone buys stock for $10 a share. It grows to $100 by the time they die. The heir inherits it. Their basis is
$100 per share. Stepped up.
And if the heir then sells it relatively soon after for $115,
their taxable gain is only $15 per share, the difference between the $115 sale price and the $100 stepped-up basis.
Okay, compare that to if the step-up didn't happen, if the heir was somehow stuck with the original $10 basis.
Right. If they had that carryover basis of $10, selling at $115 would result in a capital gain of $105 per share, $115, $10. The step-up rule removes the tax liability on that $90 of gain, $110, that occurred before death.
So $15 of taxable gain versus $105.
Exactly. That difference highlights the incredible power, the immense financial benefit of the step-up in basis for beneficiaries inheriting appreciated assets.
That example really drives home the point. Now let's compare this directly, you mentioned this earlier, to receiving that same appreciated property, not through inheritance, but as a gift during the owner's lifetime.
Yes, and this is where the contrast becomes a really essential piece of estate planning strategy. If that same asset, let's use the stock, bought for $10 and now worth $100, was gifted to you during the original owner's life.
Okay.
The tax rules say you generally take on the original owner's cost basis. This is known as a carryover basis or sometimes transferred basis.
So if my grandparent gifted me that stock worth $100, but they bought it for $10, my basis would be $10.
Correct. Your basis is carried over from the grandparent. It's $10.
And if I then turn around and sell that gifted stock for $115,
your taxable capital gain is $115 sale price minus your $10 carryover basis. The entire appreciation from the original $10 purchase price all the way up to the $115 sale price is potentially taxable to you, the recipient of the gift, when you sell it.
Wow. Okay. So the takeaway here is huge, especially for assets that have gone up a lot in value, like, stocks held for a long time or real estate. Inheriting property through an estate is generally far, far more tax efficient for the beneficiary than receiving it as a lifetime gift.
Absolutely. Miles more efficient from a capital gains perspective. This is precisely why financial advisors and estate planners often recommend holding on to assets that have appreciated significantly during your lifetime. Let them pass through your estate.
So your heirs get the step up.
Exactly. So your heirs get that valuable step up in basis. Conversely, if you want to be generous and gift assets during your life, it's often more tax-wise to gift assets that have not appreciated much or perhaps have even decreased slightly in value, because the tax consequences for the recipient selling those later would be much less severe or potentially even result in a deductible loss for them if the value is below your original basis.
That makes perfect sense. Gift the low appreciation assets, hold the high appreciation assets for inheritance.
That's a common strategy, yes. Maximize that step-up benefit.
This step up in basis seems particularly impactful, as you said earlier, when we look specifically at real estate, especially property that's been in a family for generations.
It truly is. Real estate is often unique in that way. It's a tangible asset. People tend to hold on to it for very long periods, decades, maybe even longer. And during that time, particularly in certain markets or over long historical stretches, it can experience absolutely massive appreciation.
Right.
The Investopedia source provided a really compelling illustration of this. Imagine a house maybe bought by great-grandparents for $100,000 a century ago.
Okay, 100 years.
And maybe it's stayed in the family, passed down, and now, today, it's worth $3 million.
Wow. Okay.
If it passes through the family via inheritance at each stage, the step up in basis occurs at each death. This means the current heir, the one inheriting it now at $3 million, their basis is likely very close to that $3 million fair market value at the time of the most recent death.
So if that heir decides, okay, I love the memories, but I can't keep this $3 million house, and they sell it for $3 million or maybe slightly more, say $3.1 million.
Their capital gains tax could be minimal, perhaps only on that extra $100 K gain since inheritance, or maybe even zero if they sell right away at the $3 million value, despite the fact that the property gained $2.9 million in value over the past 100 years.
That $2.9 million of appreciation accrued over a century just vanishes for tax purposes.
Exactly. It passes to the heir completely tax-free thanks to the step-up occurring at each generational transfer through inheritance. Now, contrast that with the alternative. If somehow that property had been gifted decades ago, maybe from the grandparents to the parents, the recipient could be looking at a potential capital gains tax bill based on that original $100,000 basis from 100 years ago.
That would be an astronomical tax liability on that $2.9 million gain, potentially devastating.
Absolutely. It highlights the immense difference between inheriting and gifting highly appreciated, long-held real estate.
Now, primary residences do have that special capital gains exclusion when you sell your own home, right? The $250,000 for single filers, $500,000 for married couples filing jointly. How does that interact with the step-up?
It's a good point. That exclusion applies when you sell your own primary residence that you've lived in for the required time. It can certainly help reduce or eliminate gains. However, the step-up advantage for inherited property, especially properties with very large long-term appreciation, like that generational home example, can be exponentially more significant.
Right.
In many inherited scenarios, the step-up might already bring the basis so close to the eventual sale price that the primary residence exclusion becomes almost irrelevant for the heir. The step-up might have already eliminated most, if not all, of the gain that the exclusion would have otherwise covered. The step-up often does the heavier lifting for those huge long-term gains on inherited property.
Got it. So the step-up is the really powerful tool here for wealth transfer without triggering massive capital gains taxes on that accumulated appreciation over time.
Precisely. It's a cornerstone of how appreciated assets pass between generations in the U.S. tax system currently.
Okay, so the step-up is incredibly beneficial for inherited assets, especially real estate. What about assets held in trusts? Does putting property in a trust affect whether it gets a step up in basis when the person who created the trust dies?
It absolutely can, yes. And it depends crucially on the type of trust involved.
Okay.
For assets held in a revocable trust, which is sometimes called a living trust,
Right, I've heard of those.
they typically do receive a step up in basis upon the grantor's death. The grantor is the person who created the trust.
Why do revocable trusts get the step up?
It's because assets held in a revocable trust are generally still considered part of the grantor's taxable estate for federal estate tax purposes. The grantor usually retains control and can change or revoke the trust during their lifetime. Since the assets are included in their taxable estate, they qualify for the step-up in basis rule under Section 1014 of the Internal Revenue Code.
Okay, so revocable trust generally gets step up.
Yeah.
What about an irrevocable trust?
That's typically the opposite situation. Assets transferred into an irrevocable trust are usually designed specifically to be removed from the grantor's taxable estate. The grantor gives up control.
Right.
Because these assets are generally not included in the grantor's taxable estate at death, they typically do not receive a step-up in basis upon the grantor's death. The trust itself, or the beneficiaries who eventually receive the assets from the trust, take on the grantor's original cost basis, that carryover basis we talked about with gifts.
Wow, that's a really significant difference. So if You put a highly appreciated piece of real estate into an irrevocable trust, maybe to protect it or for estate tax planning reasons. You might be sacrificing that valuable step-up benefit for your heirs down the line.
That's often the trade-off, yes. You might achieve other goals like asset protection or reducing potential estate taxes if your estate is very large, but you generally lose the income tax benefit of the step-up on those assets held within the irrevocable trust. It's a major consideration when deciding whether and how to use irrevocable trusts for highly appreciated assets. However, as the Eagle Strategies source points out, there are some sophisticated trust strategies that estate planners sometimes use to potentially navigate this. It gets complex, though.
Like what? Any examples?
Well, for instance, certain types of marital trusts can sometimes be structured to potentially offer what's informally called a double step-up. The assets get a step up at the death of the first spouse, and then potentially again when they pass to the final beneficiaries after the surviving spouse's death. Depends on the trust structure.
Okay.
Another technique mentioned, particularly for certain types of grantor trusts where the trust income is still taxed to the grantor, is including swap powers. This power might allow the grantor, or sometimes the beneficiaries, depending on how the trust is written, to exchange assets of equivalent value between their personal holdings and the trust.
How would that help get a step up?
Well, a beneficiary who holds cash or maybe some high basis assets personally could potentially exchange those with the irrevocable trust for a highly appreciated, low basis asset that's inside the trust. This effectively moves the appreciated asset out of the irrevocable trust and into the beneficiary's personal name and ownership.
I see.
If the beneficiary then holds that appreciated asset until their own death, then it would be part of their estate and could potentially be eligible for a step up in basis at that time, benefiting their heirs. It's an advanced strategy, a way to try and get appreciated assets back into a position for a future step up. But it definitely adds complexity and requires careful planning.
That sounds really advanced. It definitely highlights the importance, as you said, of getting expert legal and tax advice when dealing with trusts and highly appreciated assets. It's not DIY territory.
Absolutely not. Trust law and tax implications are complex. What about community property estates? You hear about those sometimes. Is there a special rule for married couples there regarding step-up in basis?
Yes, there is, and it's a very favorable rule that differs significantly from the rules in common law states, which is most states.
Okay.
In the 9 community property states, that's Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, there's a special rule for community property owned by a married couple. When one spouse dies, the step-up in basis applies not just to the deceased spouse's half of the community property,
But to the surviving spouse's half as well.
Exactly. The Investopedia source emphasizes this point. The surviving spouse gets a full step-up to fair market value on the entire property, both halves.
Wow. So if a couple in California bought a house together years ago for $200 as community property, and it's worth $1 million when one spouse dies, the surviving spouse's basis in the entire house becomes $1 million.
That's generally how it works for community property in those states,
Yeah.
yes. It can be a significant tax advantage for the surviving spouse if they later decide to sell the property compared to what happens in a common law state.
What happens in a common law state typically?
In most common law states, if a married couple owns property jointly, say as joint tenants with right of survivorship, generally only the deceased spouse's portion, usually assumed to be half, gets the step up in basis. The surviving spouse's original basis in their half just carries over. So in that $1 million house example, the survivor's basis might only step up on half the value, resulting in a total basis somewhere between the original cost and the full market value. The community property rule provides a full step up.
Okay, so living in a community property state can mean even greater capital gains tax savings for the surviving spouse when it comes to appreciated community property. That's a big difference.
It really is. It's a unique feature tied to those state property laws. Now, just for added context, because people sometimes get confused about different taxes related to inheritance, it's helpful to briefly distinguish the step-up in basis, which affects capital gains tax on sale, from other potential taxes you might encounter.
Good idea. Keep them straight.
Empower mentions 4 main types of taxes potentially in the mix. We've been laser focused on capital gains tax and how Step Up minimizes that specific tax when you sell an appreciated inherited asset. What are the other 3?
Okay, so besides capital gains tax, you have the federal estate tax and potentially state estate taxes. These are taxes imposed on the total value of the deceased person's estate before the assets are distributed to the heirs.
But these only apply to really large estates, right?
Exactly. They only apply to very large estates. For 2025, the federal estate tax exemption is quite high, $13.99 million per individual. That means an estate generally has to be worth more than that amount before it potentially owes any federal estate tax. Most estates fall well below this threshold.
So not something most families encounter at the federal level. And estate taxes.
A number of states do have their own state estate taxes, and often their exemption thresholds are much lower than the federal level.
Yeah.
So it's possible an estate might owe state estate tax even if it owes no federal tax. The Empower source lists the states that currently have an estate tax.
Okay, so estate tax is on the overall value of the deceased's estate, paid by the estate itself, usually only for the very wealthy. What about inheritance tax? That sounds similar but different.
It is different. An inheritance tax is a tax imposed directly on the heir, the person receiving the inheritance. The amount is based on the value they receive and often their relationship to the deceased person.
Is there a federal inheritance tax?
No, the federal government does not have an inheritance tax. However, a handful of states do impose one. The source lists them. Iowa, though it's being phased out, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania.
Only 6 states currently.
Right, and these states often have exemptions or lower tax rates based on who is inheriting. For example, spouses and direct descendants like children are often exempt or taxed at very low rates, while more distant relatives or unrelated heirs might pay a higher rate. Maryland is kind of unique. It's the only state that currently has both a state estate tax and a state inheritance tax.
Okay, so estate tax is on the giver's total wealth at death, if large enough, paid by the estate. Inheritance tax is on the receiver, based on what they get and who they are, but only in a few states. What's the fourth tax type? Income tax on inheritance.
Generally, and this is a key point, you do not pay federal income tax on the value of the assets you inherit directly, whether it's cash, stocks, or real estate like we've been discussing. The value you receive isn't considered taxable income to you.
Okay, that's good news. Are there exceptions?
The main exception, as Empower highlights, relates to inherited assets from pre-tax retirement accounts. Think traditional IRAs or traditional 401k.
Ah, right. Money that hasn't been taxed yet.
Exactly. The contributions and earnings in these accounts grow tax-deferred, meaning income taxes haven't been paid on that money yet. So when an heir withdraws money from these inherited traditional retirement accounts, those withdrawals are typically taxed as ordinary income to the heir in the year they take the money out. There are specific rules about how quickly non-spouse beneficiaries usually have to withdraw the funds, often within 10 years now under the Secure Act rules for many.
Okay. What about inherited Roth accounts? Roth IRA, Roth 401k.
Those are different because they were funded with after-tax dollars. So qualified distributions from inherited Roth accounts are generally tax-free to the beneficiary, just like they would have been for the original owner.
Okay, so to be crystal clear then, the step-up in basis, our main topic, is a rule that specifically impacts the potential capital gains tax you might owe only when you sell an inherited asset like stock or real estate. And it's completely separate from estate taxes on the deceased estate, inheritance taxes on the heir in a few states, or the income tax that's sometimes owed on distributions from inherited retirement accounts.
It's exactly right. Step-up deals purely with the basis used to calculate capital gains on the sale of inherited capital assets, mostly non-retirement assets. It targets that potential tax liability on the appreciation that accumulated over time before the original owner passed away.
Now, given how significant this tax benefit is, wiping out potentially huge amounts of taxable gain is the step up in basis. Well, is it controversial? Is it ever described as a loophole?
It is definitely a subject of ongoing political and economic debate. And yes, the term loophole is often used by critics. Sources like Investopedia and Empower present these differing viewpoints pretty clearly.
What's the argument for calling it a loophole?
The core argument that it is a loophole stems from the fact that it allows substantial wealth, often built up through decades and decades of asset appreciation, to pass from one generation to the next without any capital gains tax ever being paid on that specific amount of appreciation that occurred during the original owner's lifetime. The tax liability on that gain isn't just deferred, it's effectively eliminated forever. Critics argue this primarily benefits wealthier families who hold significant appreciated assets and contributes to, or at least perpetuates, wealth inequality by allowing large gains to escape taxation entirely.
Okay, I can definitely understand that perspective. It's a lot of potential tax revenue being bypassed. What's the counter-argument, the reasons why it's defended, or maybe seen as a necessary feature of the tax code rather than a loophole?
There are several key arguments in favor of keeping the step-up rule. One major point often raised is about preventing double taxation.
How so?
Well, the argument goes like this. If an estate is large enough to potentially owe estate tax, remember, estate tax is calculated based on the fair market value of assets at death, which includes all that appreciation. And then, if there were no step-up, the heir sells the asset and has to pay capital gains tax, again, on that same appreciation. Well, that appreciation would effectively be taxed twice, once by the estate tax and again by the capital gains tax. Supporters argue the step-up prevents this potential double hit.
Okay, that makes sense. Avoid taxing the same value increase twice. Any other arguments?
Another common argument is that eliminating this step-up could discourage long-term saving and investment. If individuals know that their heirs will face a huge capital gains tax bill on all the accumulated gains when they inherit long-held assets, they might be more reluctant to hold on to those assets. They might feel pressured to sell assets before death just to avoid sticking their heirs with the tax bomb, which could lead to less efficient investment decisions. Eagle Strategies also points out that the step-up can encourage assets to be held and reinvested within families, rather than being churned or sold purely for tax timing reasons near the end of life. And then there's the sheer practical difficulty we'll get into about tracking basis without it.
So that frames it more as a deliberate policy choice with intended economic consequences encouraging holding assets, preventing double tax, rather than just an unintended loophole that lets gains escape.
Exactly. There are policy arguments on both sides of the debate.
Given the potential value of these appreciated assets passing at death, especially with real estate and stock market gains over decades, this step-up provision must represent a really significant amount of unrealized and ultimately untaxed gain each year, right?
It absolutely does. The Investopedia source cites estimates, for instance, from the nonpartisan Peter G. Peterson Foundation, suggesting that the step-up in basis provision costs the U.S. Treasury tens of billions of dollars in potential capital gains tax revenue annually.
Tens of billions.
Yes. The estimate mentioned was around $58 billion for 2024 and projected to rise in future years as asset values potentially increase. That's a substantial figure in terms of federal revenue.
$58 billion. Wow. That kind of number usually gets the attention of policymakers, especially those looking for ways to increase government revenue or address budget deficits. So is there active discussion or have there been concrete proposals to change or even eliminate the step-up rule?
Yes, there definitely have been. It's been a recurring topic in tax policy debates. Both Investopedia and Eagle Strategies mention specific proposals, including some put forth during the Biden administration, that have called for either eliminating the step-up in basis entirely or significantly modifying it.
Modifying it how?
Sometimes the modifications proposed involve setting thresholds. For example, maybe the step-up would still apply up to a certain amount of gain, say the first $1 million per person, but gains above that threshold would become taxable upon death or carry over to the heirs. Other proposals might link it to the heir's income level. There have been various ideas floated.
Okay. What's the stated rationale usually given for these proposals to limit or end the step-up?
The logic often cited by proponents of change is twofold. First, as we discussed, to increase federal tax revenues by capturing taxes on those large accumulated capital gains that currently escape taxation at death. Second, proponents might argue it would make the tax system fairer by treating gains realized at death more similarly to gains realized during life, and potentially encourage capital gains realization during life, meaning people might sell assets more readily, triggering tax then.
But what are the potential complications or downsides if the step-up were eliminated or significantly curtailed? What are the arguments against making that change?
Eagle Strategies outlines some pretty significant practical challenges. Probably the biggest one is the sheer administrative nightmare it could create regarding tracking historical cost basis.
Right, we touched on that.
Imagine inheriting a family farm or a small business that was started, say, in the 1950s or 60s. How would the heir realistically track down the original purchase documents, receipts for every single capital improvement made over 70 years, records of any stock splits or dividends for inherited shares? For assets held for many decades, perhaps even passing through multiple generations already, finding that accurate historical cost basis could be incredibly difficult, if not practically impossible for many families.
That sounds like a record-keeping disaster waiting to happen.
It really does. It could lead to immense compliance burdens and potentially inaccurate tax calculations. Secondly, as we discussed earlier, eliminating this step-up fully reintroduces that potential for double taxation, where the same appreciation in value could be subject to both estate tax, if the estate is large enough, and capital gains tax, when the heir eventually sells.
So, while the idea of taxing those unrealized gains at death might seem simple on the surface, the practicalities of actually getting rid of the step-up seem really complex and could create significant new burdens and potential inequities for families.
Absolutely. It's not a simple switch to flip. As Eagle Strategies concludes on this specific point, the future of the step-up provision is, well, uncertain. It's been proposed for change multiple times, often as part of larger tax reform packages, but significant changes haven't yet been enacted. Whether any modifications ultimately become law, only time will tell. It's definitely an area to watch closely if you're involved in estate planning or if you expect to inherit significant appreciated assets.
This whole deep dive really underscores just how critically important understanding your basis is, especially how it's handled upon inheritance with the step-up rule. It impacts both planning your own estate and how you manage assets you might receive as an inheritance.
It truly is foundational knowledge for wealth transfer. Knowing these rules allows you or your advisors to make much more informed decisions about how assets are titled, how they're transferred, and what the potential tax consequences might be down the line for your beneficiaries.
It seems like strategic gifting, which we touched on briefly when we compared to inheritance, becomes a really key planning lever once you understand these basis rules, doesn't it?
It absolutely does. As the Empower source points out, for individuals who have significant assets and might be concerned about potential estate taxes or just want to pass wealth efficiently, using lifetime gifts strategically becomes very important.
So again?
Well, you can use the annual gift tax exclusion, which is $18,000 per recipient per year in 2025, to gift assets during your lifetime without incurring any gift tax and without using up your larger lifetime estate and gift tax exemption amount.
Okay.
A common strategy based on the basis rules is to gift those assets that have not appreciated much in value, or maybe assets that have a high basis already relative to their current value. Gifting these uses the annual exclusion effectively and helps reduce the overall size of your potentially taxable estate.
Right. Get the low-gain stuff out of your estate tax-free using the annual gift exclusion.
Exactly. Meanwhile, you strategically choose to retain those assets that have experienced significant appreciation, your highly appreciated stocks, your long-held real estate. You hold on to those until death.
Why hold those specifically?
So that those assets receive the valuable step-up in basis when they pass to your heirs through your estate. This maximizes the income tax benefit for your heirs, potentially saving them a fortune in capital gains tax compared to if you had gifted those appreciated assets during your lifetime.
So the simple version is give away the less appreciated stuff while you're alive, up to the annual limit, to reduce your future estate tax exposure, and hold on to the really highly appreciated stuff so your heirs get that wonderful stepped-up basis benefit when they inherit it.
That's the general principle, yes. If your primary goal is to minimize the overall potential tax burden, both estate tax and capital gains tax, on the transfer of wealth to the next generation.
Okay. Now, given all the complexities we've navigated today, calculating initial basis, tracking all those adjustments over years, the stark difference in tax outcomes between gifts and inheritance, the nuances with revocable versus irrevocable trusts, those special community property rules, and then layering on the uncertainty about the future of the step-up rule itself. Trying to figure all this out on your own could feel pretty overwhelming, I imagine.
Oh, it absolutely can be extremely overwhelming for most people who aren't tax professionals. And this is precisely why both the Eagle Strategies and Empower sources strongly emphasize the value of seeking professional advice.
It's not really a DIY project.
Definitely not for anything beyond the simplest situations. Talking with a qualified financial advisor who understands estate planning, or better yet, working with a specialized tax attorney or an estate planning attorney, is highly recommended.
What can they do specifically?
They can look at your complete financial picture. Your assets, your liabilities, your income, your family situation, your long-term goals. They can help you understand exactly how the current laws, including the step-up rule, apply to your specific circumstances. They can assist you in developing a comprehensive estate plan or revising an existing one to potentially take the best advantage of the rules as they exist today. And importantly, they can help you think through strategies to prepare for potential future changes in tax law.
So it's not just about knowing the rules in theory, like we've discussed today, but getting that tailored, personalized guidance on how they impact your unique situation and your specific family goals.
Exactly. Professional expertise is really key to navigating these potentially complex waters effectively. It helps ensure your assets are transferred in a way that aligns with your wishes while minimizing unnecessary tax burdens and administrative hassles for your loved ones down the road.
Okay, let's try and bring this deep dive together then. We started by considering that really emotional moment of inheriting a family home, maybe, and then realizing the practical financial questions that inevitably come along with it, particularly around taxes. We've learned that basis is essentially your investment in property for tax purposes. It's a number that starts based on how you acquired the property, whether you bought it, built it, etc., and then it changes over time with capital improvements you add and deductions like depreciation that you subtract.
Right. And the absolute core takeaway for inherited U.S. real estate and other inherited capital assets is the step up in basis. This incredibly powerful rule effectively resets the property's cost basis to its fair market value at the date of the owner's death.
And the huge benefit of that.
It effectively wipes out the potential capital gain tax liability on all the appreciation, all the growth in value that occurred during the entire time the deceased person owned the asset.
This offers a massive tax advantage to heirs, especially when compared to receiving that same appreciated property as a lifetime gift, where the original owner's lower basis typically gets carried over to the recipient.
Absolutely. It means heirs can potentially sell inherited real estate or stocks or other capital assets with little to no capital gains tax liability on all that prior growth. You can save them potentially thousands, even millions of dollars in taxes, depending on how much the asset appreciated.
So understanding basis, and particularly the step-up advantage for inheritances, is really essential for anyone involved in estate planning, whether planning their own estate or managing assets they've inherited. It really requires careful consideration of how assets are titled, how they're transferred, and the timing of those transfers.
Couldn't agree more. It's fundamental to smart planning.
Absolutely. So here's a final thought for you, our listener, to consider based on everything we've explored today. The step-up in basis is currently, a cornerstone of how wealth transfer works in the U.S. tax system, providing a substantial, undeniable benefit to heirs inheriting appreciated assets. However, as we've discussed, it's also a highly debated provision. It's seen by some as a major loophole that fuels inequality, and by others as an essential rule needed to prevent double taxation and encourage long-term investment. And critically, it has been targeted for potential change or elimination in political discussions. So as you think about your own financial future, or your family's legacy, and the journey of your assets across generations, how does the existence and the potential uncertainty surrounding the future of this step-up in basis rule influence your perspective? Does it change how you think about saving, investing, or any planning conversations you might have with your family or advisors?
It really highlights that tax laws aren't static, are they? They're dynamic, often tied to broader economic goals and political discussions. And that just makes it all the more vital to stay informed and, as we've said, seek expert guidance tailored to your situation.
A fascinating and financially significant look into the world of cost basis and inheritance. Thanks so much for joining us for this deep dive.